Thank you everyone for joining Darien Library this Wednesday evening for the basics of investing. Kristen Jacks is a financial educator and the author of Money in Your Twenties. Kristen studied financial planning at Boston University's Center for Professional Education. She started her career at Kiplinger's Personal Finance magazine and later worked at Mutual Funds magazine. Kristen is a graduate of Duke University. We're lucky to have her here tonight, and if you are interested in any of her books, we do have some in our collections. Before we begin, I would like to mention that programs at Darien Library are made possible by the annual Friends of the Library campaign. We thank you for your support to make programs like this, as well as our collections available to the community. I'm now going to pass the mic over to Kristen. Thank you very much.
Okay, perfect. Thank you, Amanda. And hello, everyone. By the way, Amanda's 9-month-old daughter is adorable. And I'm just going to have to stay focused because I was having a baby moment. She's just the cutest. But I'm so glad you're here. And thank you for having me, Darien Library. I'm going to share my screen because there's a lot to cover. So let's see what we've got. Close this, and launch this. Okay, perfect. All right. This is the basics of investing. We have a lot to cover. Just going to get started. And, for a lot of people, their view of investing, certainly what grabs the headlines are the stocks that you just wish you had gotten in early, right? Like if you had only known about Disney in the 50s, if you'd only known about Netflix. And then, usually by the time you find out how hot a stock is, it's too late. But very often people are excited about investing because they're excited about stocks. But it's interesting to just look at what is investing. And if you go on Investopedia, which is actually a great site, if you're ever interested in just sort of general terms or just information about investing, that's a very trustworthy site, Investopedia. And their definition of investing is the act of allocating resources, usually money, with the expectation of generating an income or profit. You can invest in endeavors such as using money to start a business, or in assets such as purchasing real estate in hopes of reselling it later at a higher price. So isn't that an interesting definition of investing? What's missing? It doesn't even mention stocks. So the Investopia definition is the true definition of investing. You're putting your money towards something, kind of hoping for a gain, and it could be all sorts of things, a business, real estate, things like that. We are just going to talk about the most popular investments, especially for someone just starting out. Those are stocks. But we're also going to talk about bonds. That's essential to understanding stocks and bonds and the differences between them. And then mutual funds, because that's kind of where you invest. Let me go to the next, let me go to the next stream. So where to start, with investing and what to talk about if we only have 1 hour. We're definitely going to cover the stocks and bonds, but it's kind of a surprise for a lot of people that where you start with investing, to truly understand investing, you're going to start with taxes, because taxes are an integral part of everything that we do with money. And if you don't understand taxes, you're not going to understand a lot of things. So that's where we're going to start, and hopefully it'll be interesting and fun. Don't worry. Then we're going to get right down into stocks and bonds, and we're going to talk about some key distinctions, because a good way to understand stocks and bonds is just to compare them. Hopefully that gives you some anchor of really understanding what's going on between stocks and between bonds, and kind of get a feel for what they really are. We're also going to debunk one of the myths that I think is very dangerous for people who invest. Especially the irony is if someone's trying to be careful and they go, I'm afraid of investing, I'm going to be safe, I'm going to go into bonds, because there's many treacherous things that can happen around investing in bonds. And you just have to know, if you're going into them because you're trying to be safe, you have to know what you might be getting into. We're obviously going to talk about stocks, like, trying to understand them and understand how they are valued, and certainly understand the language around stocks, which can be very confusing and intimidating. We're going to talk a little bit about mutual funds, because that's probably how people invest. A lot of someone's first time investing is being asked to fill out, 401k documents at a job and say, well, what, mutual fund do you want to go into? We're going to talk about 401ks and IRAs briefly, because that's kind of where people invest. And it also circles back to the whole tax idea. And if we have time, we're going to talk about my favorite investment, which is you. It's a totally valid investment. If you can, through investing in yourself, boost your earning potential, then you are probably your best investment. Okay, so before we get started, let's just be really clear that there's savings, investing, and then there's speculating. And if you've been following the news for the last couple of days, there is a lot of wild speculating going on. There are just, headline grabbing stories about various stocks going up over 100% in a day. And it's wild and crazy. And that has nothing to do with what we are talking about, even though it is stocks and someone's buying them. That is speculating. That is not investing. So if you start with the most conservative with money, is just saving someplace very, like a savings bank. It's guaranteed, FDIC insured. That's, where to park your money, no risk, low return. That's savings. Then there's investing, where you really are thinking you're going to make more on your money, and you're going to accept a little more risk at least to make more on your money. And that's going to go into, like we said, it could be real estate, it could be bonds, it could be stocks, it could be investing in yourself. And then, speculating is the thing we're going to stay away from. We're not going near Bitcoin. I have Zoom here, even though we're on Zoom now, which is wonderful. The reason I have it here is that because Zoom has run up so spectacularly in the pandemic, it's literally speculative at this point if you were to try to get into it. And let me just say a little bit about asking questions. Let me just see if there's anything in the chat right now. What is in the chat? Probably comments about the cute baby. Yes, of course. Okay, so Amanda will alert me if you have questions. Definitely, put them in the chat, and then if I don't see them, I won't see them. But Amanda will check them out for me, and I'll pause and try to answer them. Okay, so let's keep going. All right, where to begin? This is surprising for a lot of people, but taxes and then tax shelters are really, like, what's going on with taxes. That's kind of the impetus for investing for a lot of people. So, not somebody who's speculating or someone's into these wild stories about cryptocurrencies, but for a lot of people, they are introduced to taxes through like a 401k or an IRA, or they're getting, hurt by taxes, and they're going to look for ways to lower their tax bill. So in order to understand what I'm saying, it's really important that you understand progressive taxation. That's the system under which we are taxed by the federal government, and very often people are taxed that way. Certainly in Connecticut you are. At the state level also is a progressive tax system. But let me just start with the federal government. So people are not just taxed a straight amount or a flat amount on their income by the federal government. So Social Security, that tax is a flat amount. Medicare, that tax is a flat amount. So you can plan for it, it's predictable. But progressive taxation is different. With progressive taxation, the more you earn, the greater percentage you pay on certain chunks of money. And this is what makes it really confusing. So I've tried to add a slide that helps you to understand, if you're earning money after you take the standard deduction, so every single person is entitled to $12,400 as a deduction off of their income, and that's saved from any tax. But after that, the next dollar after that is going to be taxed at 10%, okay? And then that 10%, you're taxed 10% on the next dollar after $12,400 up to another $9,875. So we'll do, this chart kind of shows the quick math. Once you get to $22,275, now you're getting taxed, those dollars are getting taxed at 12%. Okay, who cares, right? This is not a big deal. There's nothing to fret about. Nobody frets over 10%, 12% really. But, and here's a big reason why people are investing. All of a sudden, if you get to earnings of $52,525, the next dollar after that, 22% goes only to the federal government. You're still paying Social Security, you're still paying Medicare, you're still paying Connecticut state tax, which is also a progressive tax. So you're really getting hurt. So let me show you, and hopefully these charts make sense. It's a very complicated topic. But let's just look at $1. If you've crossed this threshold of 52,525, and the next dollar you earn, 22 cents is going to go to the federal government. 8 cents is going to go to FICA, which is just another way of saying Social Security and Medicare. I realized this is a New York slide because the last time I used this was for Rye Library. So excuse me, but use your imagination. Let's pretend it's Connecticut. New York State. And then actually, if you have a company based in New York City and you technically are you used to have to commute into New York City, you'd also be on the hook for New York City local taxes. So at a very low threshold, you start losing 40 cents of every dollar to taxes. And this is really tough and it makes it difficult for people to save. So we have tax shelters to the rescue. And this is, if you didn't understand it before, since this is the basics of investing, I would assume there are some young people in the audience. I was getting taxed for years before I truly understood progressive taxation. But this is why tax shelters are so great, because you divert those dollars that are getting hit by the higher tax into a savings vehicle where they don't get taxed and your money grows tax-free. And that's why, once people have really been slammed with taxes, that's why they get so excited about 401ks and the classic IRA. Very different than a Roth IRA, but the classic IRA is also a tax shelter, tax savings that saves you from your tax on your current income. The Roth does other things that are amazing, but we're not going to cover that right now. Okay, if any of this is really unusual and concerning, like if you don't recognize this, Darien Library has my book, Money in Your 20s, Getting Started. Chapter 2 is Taxes 101. It goes into everything I've said in depth and it gives examples. There's also a terrific online tool called smartasset.com. Smartasset.com has a tax calculator where you can go in and just plug in any income and then you plug in your location and it'll spit out what your taxes would be if you're not using any tax shelters. So, for example, this person's earning $70,000 in New York City and their tax is considerable. Their total income tax, if they didn't use any tax shelters, would be $19,771. That's a lot of tax for a person who's not really necessarily earning that much money. So this, again, the joy of tax shelters. I'm just going to quickly check the chat. I think we are good. All right, good. Okay, so now let's get to the fun stuff. Stocks and bonds. If you really don't understand stocks and bonds, or maybe you understand stocks pretty well, but you really don't understand bonds, I think a great way to help you is to just think about what is your relationship to the company where you hope to invest. So all of these companies here, Disney, General Motors, Starbucks, they have a stock, they issue stock, they have issued stock, their stocks are out there. And they also issue bonds. So you could either be an owner, a part owner of that company by having a share of stock, so you have a share in the company, or you could loan these companies money by purchasing a bond. So, or you could do both. You could be both a bond holder, so you're a lender, or you could, and you could be a stockholder. So you could buy a share or several shares in these companies. So I hope that owner versus lender idea has some resonance for you. Once you think of a bondholder, that you're just a lender, well, lending is usually very defined, right? You're going to say, I'm going to loan you this money for a very specific period of time. Almost every loan is defined by a period of time. Stock ownership is different. It's very unstructured. I day trade, so I might own a stock literally for an hour. There are stocks that I've owned for years. So the length of time is very different, stocks versus bonds. The whole relationship in a bond is very structured. There's going to be terms. There's going to be, you're lending a specific amount. You're expecting a certain interest rate in return over a certain length of time. Stocks are much less defined, although they do have, stocks do pay dividends. Some stocks pay dividends. And the dividend can actually be a huge part of what makes a stock valuable to you. That's not the sexy stuff that you see on the news. It doesn't grab headlines, but really getting familiar with dividends is very important. Now, if you're totally unfamiliar, a company will say, what a dividend is that a company will say, every 90 days, we're going to give a little bit of cash back to our stockholders. So a good dividend these days would be like over the course of a year, the company returns to you about 3% of the value of the company. So for example, if you had a $20 stock and you had like a 60-cent dividend over the course of a year, every 90 days, you'd get 15 cents per share returned back to you. And for a lot of people, since you can't make any money, putting your money in a bank these days, they really like dividends. It's like, well, at least I'm going to make 3% and maybe the stock will go up and I could sell it and I could make more. So dividends are a big part of what makes stocks attractive. Bonds, meanwhile, you have a guaranteed interest payment. So that's, and again, that's very fixed and that's your deal. Okay, stocks versus bonds, owner versus lender, undefined length of time versus very defined, highly variable structure, owning a stock versus very structured, and stocks pay dividends, bonds pay interest. Okay, let's get into stocks. The funny thing about stocks is that if you know the price of a stock, you actually know nothing. This is a very tricky concept to wrap your mind around. I was actually in Palmer's Market, so I grabbed, a few pictures of things where, you look at the price of coffee and you probably have a comfort zone around it. You have an opinion about it. Oh, is it getting too expensive? Is that a good price? But, it tells you something. You're like, I get it. I can know exactly what I'm getting for my $14.59. Same thing with steak. You see a price and it registers something with you. It makes sense to you. Maybe that's too high, or maybe it's out of reach, or maybe it's too low. But you have some kind of an opinion about it. When you know the price of a stock, so today Ford stock closed at $10.79 a share. That tells you nothing. You literally know nothing about whether you're getting a good value. You know nothing about whether Ford is getting expensive. You know nothing, because to really understand a stock, you have to have more information. So let's get to that more information. Now, here is a typical chart, very easy to find. So I like Yahoo Finance. So if you go on Yahoo and you look at all the buttons at the top of Yahoo, it'll be like mail and news and whatever. One of the buttons is finance. And then when you go into that area, you have to know your ticker symbols to find a stock that you're interested in. So for example, like we were talking about Ford, the ticker symbol for Ford is just F. You know, a lot of things are just, the ticker symbol is just one letter, like Kellogg's cereal, the ticker symbol is just K. If you don't know the ticker symbol, it's very easy to Google, you know, what is the ticker symbol for, but if you're interested in a certain company, you're going to have to know their ticker symbol. So here, let's get into Ford. Okay, so we knew one share of Ford stock was $10.79. And the reason I say that doesn't tell you anything is that until you know how many shares are out there in the universe, you don't know anything, because a stock is really based on its price times all the shares that are outstanding. So if you have a stock and, you know, say you have a $10 stock and you find out there are 1 million shares outstanding, the value of the company is $10 million. Now, in the real world, stocks are, you know, you could have a $10 stock, there are 1 billion shares outstanding, and then the value of the company is 10 billion. That's probably a better example. So with stocks, you're actually really trying to get at what is the value of the company, and that value is called market cap. And you can see it on this chart. Right at the top, like if you you go under where the price is, and you see previous close, just go across and you'll see market cap, and you'll see that the entire Ford company is valued at $42.9 billion. And that number is just the number of shares outstanding times the price. And that's really how, you know, if you want to get into stocks, you're going to have to get into what is the market capitalization and how is that justified? How is a company worth $42.9 billion? And how can I feel like the stock is not going to go down by a lot? Because, you know, how do I know this company isn't really worth $30 billion? So getting into that sense of what a stock is worth is not something we can cover in an hour, but that's the most important thing you need to know about stocks. Is this is what professionals are trying to do. They're trying to really get at the value and trying to predict if a stock will go up because it's being undervalued, or even if it's just reasonably valued, but there's a high demand for stock ownership, which is definitely where we are today. Some theorists call it the cleanest dirty shirt theory, that people want to be in stocks, especially like if a stock pays a dividend. So even if the value is too high, they might own the stock anyway, just to kind of hold on to it and have it, and because it, you know, 5, 6, 7 years from now, it might do well. All right, I'm just going to check the chat, and let's okay. All right, perfect.
I have a question for you.
Oh yeah.
If I wanted to get started, do you have any, I don't know if you use any apps. I know that a few of my friends use Robinhood. I don't know.
I know you kids today. So this is the funny thing. You know, I am definitely like probably 10, 15 years older than you, no question. And none of these apps existed. Okay, nobody was using Acorn or Robinhood or whatever. But you know, if you like it, go for it. The old school is, you know, you go to a Vanguard or a T. Rowe Price, or a Schwab, or it's just so many different brands that, and now they're all trying to play catch up, because Robinhood lets you own like a fraction of a stock. And so that was the whole game of like trying to catch up with that concept. But yeah, I can't, all I can do say about Robinhood is it makes me feel old, but I'm sure it's fine. Unless they're charging you fees. So that fees,
I don't think so.
Yeah, any kind of hidden fee is a big deal. Okay,
we have a few other questions that popped up as well.
Yeah, I'm taking a look. Let's see. Is it easy to Whoa, it just moved. Okay, sorry. Okay, so we had, is it easy to understand dividend payout when analyzing stocks? Yes. If you go into like a typical stock screen, so like I like to go into Yahoo and then into Yahoo Finance. And for any company, it'll show you this screen. And if on this screen, you'll see that they have like the dividend information. But right now, Ford is not offering a dividend because they're in like serious trouble. So, it's very easy, or you could just Google, if you're interested in a particular stock, you just Google like, what is General Motors dividend, or, what is Starbucks dividend? And the information will pop right up. You just have to make sure you understand that it's paid every 90 days. So, they'll say like, oh, the payout is 3%. And then you get this paltry amount and you go, wait, I thought the dividend was supposed to be much more than that. It's the 3% is over the course of a year. So you're going to get every 90 days an installment of something that adds up to the total percentage. Have you written any books or articles related to valuation of stocks? That's the book I'm working on right now. So yeah, hope it was supposed to be much further along, but it's coming. Unfortunately, the books that are out there you either have like general books, like I actually really like Get a Financial Life by Kiplinger. She's good. But there aren't a lot of people that really get into the basics and hold your hand about stocks. So that's kind of why I'm writing my book. But if you're a little further along or you're just into it, I like A Random Walk Down Wall Street is really good. Okay, so wait, what was this other? But be definitely Darien Library. I'll let you know when my next book is out. Drips are good for me as they're automatically reinvest any dividends. Oh yeah, so anything when you own like a mutual fund or stocks, you can actually ask that your dividends be automatically reinvested into the stock. That's just sort of a paperwork thing. It's a question that might come up, but that's a good point. Yeah. So instead of just having your dividends sit as cash and accumulate, you can have them reinvested in your stocks. Okay, we better keep going or we will not get through. There's a lot to cover. But anyway, this is a typical screen. And if Darien Y ever wants to do a 2-part series, then really delving into all of this information would be great. But to just stick with an hour, we got to keep moving forward. Okay, so mastering the language around stocks. The language is complicated, and I almost feel like it's intentional. There was a guy Lanchester, who wrote an entire book about how to speak money. And he noted that it's extremely difficult because very often things in the money world do not mean what they mean in the everyday world. Like a hedge fund doesn't hedge anything, a security is not secure. Like a security is literally like anything that can be traded. So one thing with the vocabulary is, if you're confused, you should be. It's almost hard to understand on purpose. And never assume you've got it, because very often what you're hearing doesn't really make any sense and you're better off Googling it. But let's just take a typical thing that you might see if you're choosing among mutual funds. When you open a 401k, it'll say, oh, would you like, a mid-cap value fund? And that can seem really hard to understand, but we've already talked about cap. Cap is capitalization. Cap is market cap. So you'll see that all the time. It's talking about the overall value of the company. So again, we're going to go back to, there's a stock price, and then there are a number of shares outstanding. And all you're doing is taking the stock price and multiplying it by how many shares are outstanding. And then that's going to give you some total value for the company. And that value, that cap, here they're just saying it's a cap. Other times you might hear market cap. That is something that's always very notable. So like when you're picking different funds, you might hear of a fund that's a micro cap fund, or a, here it's the mid-cap fund. So you're going to hear a description of how large is that capitalization, right? And you'll hear it's a large cap fund, right? Or it's a small cap fund, but it's all just talking about this market capitalization. So you're really talking about, are you talking about tiny, tiny companies like a micro cap? So hopefully this example makes sense. And Amanda, you're going to spend a lot of time at Build-A-Bear, so you're going to know this one. So Build-A-Bear is this adorable company that's in the malls. And back when people used to go there and be able to interact and you could build your own teddy bear. That's a micro cap company. It has a tiny, tiny, relatively tiny valuation. If you compare like Build-A-Bear to Amazon, like you couldn't even put them on the same chart. It's like Build-A-Bear is a speck. It has a tiny, tiny value, and Amazon is enormous. So that's where the whole cap language is coming from. So if you're looking at a mutual fund, it'll say, large cap value fund. So you've mastered the first part. The first part is just talking about size of companies. The second part is you'll hear all the time value or growth. And growth is, I feel like, easier to understand because it's all the hot stuff, like when you, back when Netflix was not very well known, but it was growing, in leaps and bounds. When Zoom was not very well known, but look where we are today. So those companies that just kind of take off and grow and grow and grow, and the ones that grab the headlines and everyone gets excited, those are the growth stocks. They are growing. Then you have kind of regular stocks that are just neither here nor there, but then you have value. So value stocks are more almost the sense that they're undervalued. They're just a little bit boring, like Kellogg cereals. Kellogg as a company, I know they do a lot more than cereal, but Kellogg is a great sort of, has a decent dividend, has a very reasonable price. A lot of people would say it's a good value. So really, when you talk about, a lot more things can kind of fall into the value area, meaning that they are just definitely not growth. They're not Netflix, they're not Zoom, they're not these companies that are just taking off. Okay, so I hope that helps with just kind of getting some sense of the language. But really, whenever you're confused, just realize you're supposed to be confused. It's confusing. And if you don't take the time to Google things and try to learn, that it's not intuitive. It's the language of money. Words don't mean what they mean, on a daily basis. Okay, so going into bonds. Bonds are, again, we've decided bonds are a loan, and we only talked about companies where, Starbucks can issue bonds, can borrow money, and you can lend them money. You can be a bond holder. We've only talked about companies, but really, bonds are everywhere. So like towns can issue bonds. The United States government obviously issues bonds. So you can loan money in a lot of different ways to, when a town does it, a municipality, that's probably, you've heard of muni bonds. It's a muni bond because it's a municipality that wants to raise money by getting a loan and, and issuing bonds so that they can raise money by agreeing to pay it back, at some reasonable time and reasonable rate. Okay, so my least favorite notion in personal finance is that bonds are safe. This really bothers me because people get hurt. People who want to play it safe go into bonds because they don't like risk and they don't understand that bonds are risky. So let's talk about that. First of all, not all bonds are created equally. So just like bonds have a credit rating. There are bond rating agencies that assess the credit worthiness of a bond and they give it a rating. And, it's highly unlikely if you're just starting out that you personally are going to start buying individual bonds, but you should at least understand the concept. If you go into a bond mutual fund, you want to make sure you're only getting high quality bonds and no junk bonds. And Junk bonds is a term, it's not a great term because those bonds aren't necessarily junk. It just means that they don't have the same credit. Think of it as someone who has like a much lower credit score, right? Like if you were a person, you'd want like the person to have a credit score of 720 or above, right? 720, 750, 800, something like that. You don't want to be lending money to people who have like, a 600 credit score. Well, with junk bonds, there's a real range of how those, the ratings, there's a real range. And there's a lot of risk. So it's not that all junk bonds are bad, but you definitely want to know what you're getting yourself into. And the news is that junk bonds have been creeping into what would normally be considered very safe bond mutual funds. So you really want to read the fine print of what you're getting yourself into. And then kind of a fun exercise, if you wanted to, is just to, kind of write these down or take a picture of it and try to figure out, which of these has the best rating and which of these has the worst. Just a little fun homework. Okay, debunking bonds are safe. So in order to understand why bonds are not safe right now, you have to understand how interest rates impact bonds. So I'm going to talk about the good old days. The good old days, for the last many, many, many years, where interest rates have been coming down. This is how you make money in bonds. So say you decide to, and I'm doing this very simply because obviously, hardly anyone, maybe nobody in our audience is going to go out and do a personal bond to Starbucks. They're going to go into a bond fund, but this is how it would work. So Starbucks issues some bonds. You say, I like Starbucks. That's a good bet. They've got a good rating. Oh, they're paying 5%. Okay, I'm going to loan them $1,000 for 5 years at 5% interest. Well, then interest rates come down. So now, you're holding this bond, you've held it for 2 years, and now interest rates have come down, and no one can get bonds that are, paying out 5%. That's a really good payout. In fact, they can only get bonds that pay out 3%. So the amazing thing is, what happens is how you make money in bonds beyond just the interest rate. If interest rates are going down and you're holding on to bonds that have a good interest rate relative to what's available now, someone's going to pay you more for it. So you're not only just making the interest rate money that you've made to date, someone will pay you more for that bond than what you paid for it. So you're making money two ways. People have loved bonds for years because interest rates have been coming down for years. It's all been one story, one way for years. And the problem is people start to believe the story because they don't understand the dynamics. Now everything has switched. So let me explain to you. Here's a fairly recent chart of interest rates. And you can see, there was like some up and down. For some of you who know a lot about real estate, you know a bit about the ups and downs with the interest rates. But imagine just in general, bonds have been coming down for decades, literally. But now you get to this point where bonds are so low that the 10-year, like literally what the government pays in interest for, getting a 10-year bond, fell below 1%, which is extraordinary. And then interest rates started going up because where else could they go? I mean, some people believe in negative interest rates, but I don't. So anyway, you've very low interest rates. Now interest rates start to go up. Well, here's what happens. And this is the part, sadly, a lot of people don't understand. So if they were going to go into bonds today, and they can only get a very low rate, right? You're going to buy a bond. Okay, all I can get is 3%. All right. You buy that bond, and then a few years, maybe a year from now or 2 years from now, interest rates have gone up back to normal levels because they've been so abnormal for years. And the newer bonds that come out a few years from now are paying 5%. You're sitting on bonds that only pay 3%. Well, obviously, you would much rather have a bond that pays 5% interest that one that pays 3% interest. And you can sit on your bond and only make the 3%, but what happens is there's this market where people buy bonds, before they have matured. And if you went to sell your bond, nobody would want it at 3% because the current market they could get one at 5%. So you have to give them a discount. They're only going to buy the bond from you at less than what you paid for it. And this is how you lose money in bonds. Now, it's not a catastrophic loss. It's certainly not like these horrible losses that some people incur when they speculate in like a Bitcoin or they speculate in the hot stock. But still, if you thought your money was safe, that a bond would protect all of your principal and then give you some interest, it doesn't really work that way. And it especially doesn't work that way in mutual funds where you don't have control over the buying and selling. So just keep that in mind. Okay, speaking of mutual funds, there is no cool visual for mutual funds, so I didn't even try to find one. But really, mutual funds became incredibly popular just because they offer affordability and diversification. So, it's not a good idea to just own 1 or 2 or 3 stocks. Most people know that. And they say, okay, well, I want to own a good basket of stocks, but how can I own a good basket of stocks? Really all I'm thinking of doing is putting in $200 every month into the stock market. Well, that's the beauty of the mutual funds because it gives you, there's so many, almost anything you could think of, there's a mutual fund for it. So if you just like, if for some reason you just like, grocery stores, you could go into just like the grocery store sector. Whatever you want, it's out there, but you get instant diversification and very affordable. Outside of a 401k, maybe you have to, you can only get in with $1,000 minimum payment. But when you're within your 401k at your job, I don't think it matters. It's just whatever you're willing to contribute each month, and they will put it in for you. So that's the excitement about mutual funds. Now, again, Robinhood and all these other apps kind of are disrupting this value proposition because outside of a classic mutual fund, you can own a fraction of, right now, let's see, like if you did Zoom, right? I think Zoom was at $370 per share today. And if you just wanted to own a fraction of that, like you can't even own 1 share, but now you can put together your own almost mini mutual fund with these kind of, Schwab calls them slices and, all these ways of slicing and dicing stocks. So who knows, maybe mutual funds are going to go, really be disrupted by the new way of doing things. Okay, I want to make sure we have time for questions, but I did want to, and please go ahead and add any questions to the chat. But I did want to say it's really important. I still think, especially if you're young and just starting out, definitely, get in your 401k. If your company offers a match, you'd be crazy not to save in your 401k at least up to the match. But then beyond that, investing in yourself is so smart. And I don't mean like quit your job and go back to school. I mean, taking a really influential person, like if there's a really influential person in your industry, taking that person out to lunch outside in the cold. Don't do it next week. It's going to be 28 degrees. But like, that's a way to spend money. You're sort of treating that person and showing them respect, and they have a lot of influence in your industry. That's actually a way to invest in yourself. Taking a public speaking course is a great way to invest in yourself. The research is absolutely clear that if you know how to communicate, if you have the confidence to talk in front of a crowd, it will be reflected in the amount of money that you earn. There's so many ways to invest in yourself, which, beyond just going into your 401k up to the company match, you definitely want to think about the ways that you can improve, even if it's like hiring. There's great companies that give resume writing, anything that's going to help you look more polished and professional. Anything like that is investing in yourself, which is really important. All right, let me just grab these questions. Oh, yes, I think we're going to have time to do PE ratio. So definitely. Can you recommend an online trading company? Okay, everyone that you named, Ameritrade, Fidelity, Schwab, they are all good. You cannot go wrong. So I've done both Fidelity and Schwab, and they're fine. I just have to alert you though, with all of the craziness going on in the market, if you have any inclination that you want to be doing a little day trading, all of these companies have trouble keeping up with the volatility and the demand. And, you know, because I do some day trading, they've all failed on me. I've had a situation with every company I've ever dealt with where you go to make a trade and they can't execute it. So that's just, you know, don't be surprised if that happens. And certainly, you know, we could talk about limit orders and things like that. But if you're going to speculate, if anyone out there is going to try to, like, you know, time a stock and make a quick profit, you are going to want to anticipate this and have a workaround, because it can be a little scary. Okay, so can you touch on PE ratio? Yes, we definitely have enough time. So let's go back to that chart. Oh, you know what? Oh, lousy chart. Oh, darn, lousy chart. Okay, so the chart I had wouldn't be good for a PE ratio because the company Ford had a loss. So when you have a loss, you don't have earnings. Earnings mean profit. But PE basically means price to earnings ratio. So if you think about it, the kind of company where you'd want a share in that company, it makes sense you want to share in a profitable company. And it would make sense that you know, the more that company is profitable and throwing off cash in profit, the more attractive it is. It's like, wow, they're doing something right. You know, they've found a customer base, they have a product, something's working that's, you know, making them very profitable. So what the price to earnings ratio is, you look at the price of the stock and you compare it to its earnings per share for a year. It's a little confusing without a chart, but okay. So if you have, and this is, it's very like a lot of people value companies. They want to see like the company falling in a certain range with its price to earnings ratio. So it's funny because I'm used to looking at charts and then being like, oh, wow, 25, that's good. Okay. Oh, 50, that's bad. So it's like I'm looking at the outcome of the number and having trouble explaining to you how we get to the number. Price to earnings, price to earnings. So let's see, if a stock was $10 and the earnings was $1 per share, you know, it would have a PE of 10. Is that right? Oh, okay. Next time I'm going to be more prepared for this. I'm going to be more prepared for this, but definitely you want your price to earnings ratio to like, you can see some really crazy ones out there. So like a historic, like good one for the market, like if you have like a price to earnings ratio around 20, like that was very comfortable. And now people feel like the market is wildly overheated because that price to earnings ratio is much higher. And for certain stocks, you know, the price to earnings ratio could be like over 100 because it's a growth stock and the earnings are not really measuring up yet. But the feeling is the company is growing at leaps and bounds and going to get all of these benefits from adding customers and customers and customers and being able to scale up. And so their PE will come down, but their, you know, their overall value will be fantastic. I'm butchering this, but next time I'll have a, you know, I'll have a good slide ready to make it more understandable. Okay, what else? Oh, I think this is my last slide, by the way. Oh, right. With investing in yourself, the challenge is always making sure that it's cost effective. Like, is the cost of the education or training delivering enough value if you're really going to start getting into classes and things like that? But anytime you can just network, and I think networking where you at least, buy someone a drink or send them a gift or do something nice is really a good use of your time. Okay, don't stop learning. If you were confused about any of the basics, that's definitely what my first book, Money in Your 20s Getting Started, is about. And it's available at the Darien bookstore, Barrett's. It's available in New Canaan. So that particular book is like credit scores, taxes, renter's insurance, all the basics. And then also, here's my personal information. Anyone is welcome, to email me, kjacks@moneyinyour20s.com. I will get back to that one last question, but I want to make sure, if you like Instagram, I post every day, and every day I post something worthwhile so that you can learn. Twitter is kind of a funky thing. I do that more for all the journalists that I try to keep up with. But definitely if you're on Instagram or Facebook, Instagram, I post every day something that you can learn. And then the website, for the financial literacy, the website has a lot of tools, because I say that classic budgets don't work. So I have other tools to help people kind of understand, like, how to manage their money. But in any case, let me look at this one last question. Where did it go? Oh, where did it go? Here we go. Okay. Do you need 1,000 or more to invest? Nope, definitely not. Especially now that on these apps, you can start with so little and buy shares of things. But if you want to get started, your 401k is definitely the best place. And then so with it through your job, or if you don't have that, through like an IRA, if your company doesn't offer a 401k. But no, you don't need $10,000 to get started. You could, a mutual fund, where to get started if you're not trying to speculate, just going into the S&P 500, meaning the Standard & Poor's 500. So that's the top 500 companies in the United States. Those mutual funds everyone offers them, and they're really inexpensive and they're great. So I think that's it. Amanda, do you see any more questions, or did you have any more questions?
There was a question about Apple. Did you see that one as well?
Oh,
Apple as an example, highest earnings ever just recently. Is that still a stock to invest in with a pretty high price at this point?
Oh, that's a great question. Okay, I got to tell you, people in this field are astonished. They're calling it the everything bubble. That and so one answer to your question is keep some cash on the sidelines. Most people would say, "Oh my God, don't say that. You can't time the market, blah blah blah." This is really strange. We are in very strange times. With the market has zoomed up when no one thinks that earnings can justify it, down the road. Better to get in slowly. If you have a chunk of money, when they say don't time the market, it also means you shouldn't put all your money into the market all at once, because right now the market is unusually high, but everything is unusually high. So I would say be in your 401k, because that's going to be a monthly, as you get your paycheck. That's called dollar cost averaging. That's a whole other theory of sort of like putting money in incrementally, and then you're grabbing these stocks at different prices, but over the long haul, you're not getting too high or too low. But if you have one big chunk of money, you also don't want to get in all at once. And some of the smartest people I know are talking about how they hate to say, like, don't get in or whatever, but things are just absurdly high right now. So there's a lot of concern that you could get in and you could lose 30% easily when things are so overvalued. I hope that answers your question.
And Claire's making some extra noises here. Kathleen wants to know about spiders.
Okay, so ETFs. So it used to be you just had mutual funds. So this is, now I'm really going to start to show my age. And a mutual fund, you could buy it, but it did not trade like a stock. It's not a mutual fund. You would buy it and you could get the price, whatever the price was at the end of the day, and you could buy it, and then you couldn't sell it for until another day, and then you got that one price. So it's sort of getting in. The whole idea is how you get in and you get out of the market. Spiders, all ETFs are basically these like mutual funds, but they trade like stocks. And they're kind of, it's kind of shocking. Like how does that even happen? How can anyone keep up with the price of all of those stocks, you know, to a nanosecond? But luckily that's not my job. I don't have to do that. But that's really all that's happening, is you're dealing with something that acts like a mutual fund because it's diverse. It's representing several stocks all at once, but it trades like a stock. So you could buy it and then you could sell it 20 minutes later. I'm not really sure it's definitely appealing for day traders if they want to make a bet, like, you know, on the gold, you know, if you could get a gold ETF or yeah, it's basically just a mutual fund that trades like a stock. That's the short answer. And then there are so many of them. It's, you know, which one do you want and why do you want it? Why do you need an investment that you can get in and out of that quickly? Hope that answers your question. Let's see. What's your take on selling gold jewelry? Like that, kind of like, what's my take on where is gold? Gold's pretty high right now, so good time. A lot of people think gold is going to stay high because they don't think the economy is going to do that well. So, oh, Roth IRA, yes, okay. So it's a good time to sell gold because gold is relatively high, but it's also, you know, good time to hold on to it. Roth IRA, let's talk about a Roth. Different from a regular IRA. A regular IRA, you're getting the tax savings in that year. So like when we were talking about how certain dollars were hitting, you know, the 22% federal tax bracket, and so you know, whatever tax bracket you're in, you're using an IRA or a 401k, you're diverting the money away from what you're going to have to declare you earned in that tax year. That's the beauty of a regular IRA. A Roth IRA does not work that way. It's after tax. So you might say, well, why on earth would I want to do that? That's dumb. It's because well, there are a lot of things about Roth that are amazing, but your money grows tax-free, but when you go to take the money out, you pay no tax. And that is a really exciting idea. With a regular 401k, regular IRA, the money grows tax-free, but when you finally take the money out, you pay taxes as though that is your income that you are taking out. So you just add it to your normal income. With a Roth, the money grows tax-free, and when you go to, and maybe you do great and it grows and grows and grows and grows, you go to take that money out, you pay no tax on it, as long as you follow, you know, there are a whole bunch of rules, right? It's always like, you can't be under 59 and a half, and you can't, well, if you are under 59 and a half, it has to be for a bunch of, you know, good reasons. But the other reason I love a Roth is I feel like it's better than a regular, like people say, have an emergency fund. But if you really study Roths, there are so many reasons you can take money out of a Roth penalty free that it's almost like a great emergency fund, because you can use it for the birth of a baby, you can use it for child's education. I think you can use it for buying a house. I wish I had the list in front of me, but you know, if you think about like all the reasons you might want some extra cash around, it's like, wow, why not just stick it in a Roth, because I'm getting all the benefits of it growing tax-free, and then I have no tax when I take the money out. You are a fabulous speaker. Well, thank you. Thank you very much. That's great. I do try to take complex things and make them clear. So even if I have to go into a grocery store and take pictures of the price of steak, that's, you know, that's really what I'm aiming for. And you guys have been a great audience, and thank you so much. And I'm looking forward to my next book being done too. Yes. like really looking forward to it. So thank you everyone and enjoy your
Thank you so
evening.
much for being with us tonight and for giving us this wonderful information. We really appreciate it.
Oh, my pleasure. Everyone have fun. Have a great night. Take care.